All right, so I think we can get started here. Hi everybody. This is Mauricio Gonzalez. I am one of the sales directors here at Colab Lending and also a loan officer. So thank you so much for taking the time today to come to this webinar. So we always do webinar Wednesdays, so make sure to stay tuned for more webinars to come, where we always share just different information on what we see in the lending market and the current environment that we're in. And that's something that we're really big on here at Colab Lending, is just make sure that we're educating our clients, making sure that we're educating our real estate partners to make sure that they have all the tools necessary to win out there when it comes to putting in offers and being really competitive in this market. So thank you again for coming in. Hope this information is useful and you find it very informative. And as always, at the end of the webinar, if you have any questions, concerns, feel free to reach out. We will make sure to answer any questions that you have. So thank you again, and let's get started. All right. So one of the first things that I wanted to jump into is a non-occupant co-borrower is precisely that. So there's someone who agrees to be added as a borrower, but they will not occupy the home. So in other words, they're just helping out for a variety of reasons that we're going to jump into in this webinar. So one of the biggest questions that we always get asked is, why would someone need a non-occupant co-borrower, right? So that's what we're going to cover here right now. I'm going to make this a little bit bigger. So as I'm sure many of you have experienced, there are many times when someone is financially sound and they will probably make a responsible homeowner, yet they don't necessarily meet all the rules of the mortgage lending world, right? So that is one of the biggest things where we see this non-occupying co-borrower come into play. So for example, I just had one of my borrowers that they're moving out of state, they're coming into the Pittsburgh area for school, and they also work, but they don't necessarily have, one, the credit score, and two, the income to show a little bit of stability because they have moved around and they don't have a full-time job. So it's just more of a part-time income. So in this case, we were able to use one of their parents to co-sign or be a non-occupant co-borrower on the loan to qualify for the loan. So it was a great idea for the parents to help out their kid that way and save and rent and actually own a property. And at the same time, it helped the borrower who will occupy the property because it was going to be actually a little bit cheaper to pay their parents back rather than rent. So that's one of the main reasons why we use a co-borrower in this situation. So there's home lending programs out there that work great with non-occupant co-borrowers, but there are some that don't work at all. So it's very important to know that the guidelines I'm talking about today only applies to the client's primary residence. So that's something to keep in mind as we go through this webinar today. Programs with guidelines for these type of situations are both conventional and FHA financing. And then, for example, non-occupying co-borrowers can be added on a conventional loan. So like anything that it's bought by Fannie Mae or Freddie Mac, and it's a conforming or high balance loans, we can use a non-occupying co-borrower. We can also use them on low down payment options for programs like Home Style, Home Ready, and Home Possible. Many people are surprised to find out that a non-occupying co-borrower can also be added on a refinance or a conventional cash out refinance. And this is because life can really change from time to time. And when it comes to buying a home or refinancing, depending on your situation, you might need to have a non-occupying co-borrower to help you qualify for the loan. So examples of those situations, it could be, we see this very often, it's unfortunate, but like separations or divorce, there are very good examples of when non-occupant co-borrower may be required on a refinance. There's for FHA financing, when it comes to non-occupant co-borrowers, we can use it for a standard FHA financing. It's also known as a 203B. We can use it for rehab programs as well, which are 203K loans. However, FHA will not allow a non-occupant co-borrower on a cash-out refinance. So that's something that we always have to keep in mind. They're taking money out of that refinance to pay off debt or consolidate things. We cannot have a non-occupant co-borrower. So that's something to keep in mind. They will allow rate and term. So if we're getting a lower term or lower payment, FHA does allow that. So this can sometimes be an issue when, let's say, one spouse tries to buy out another spouse in a divorce situation, what we just talked about. If they're not able to tap into that equity and we're doing an FHA loan, it could really not be helpful to get all that money out. So that's something to keep in mind only for FHA financing. Conventional is a little bit different. We can benefit from that. So other programs that do not allow for non-occupant co-borrowers are your VA loan, USDA loan, and like I said, FHA cash out, which is what we just talked about. So those are one of the programs that they do not allow anyone to have a non-occupant co-borrower. Freddie Mac has a program as well, which is called Freddie Mac Home One program. And this one, it's a low down payment option that serves needs for like first-time home buyers typically. So obviously they don't allow us to do cash out refinances and have non-occupant co-borrowers in this situation. So, all right, so let's jump on to non-occupant co-borrowers, some restrictions. So now that you know what types of programs may work with non-occupant co-borrower, I just want to touch a little bit of some of the restrictions. So with this program, the co-borrower may not be an interested party. So something to keep in mind when you purchase a transaction for a conventional loan. So examples of an interest party are like property seller. They cannot be a co-borrower on it, non-occupant co-borrower, or like the builder, if it's a new build, the real estate agent or broker, right? Any affiliate who may benefit from the sale of the property or the sale of the property at the highest price possible. So that is something to keep in mind. For home ready and home possible loans, the income earned by the non-occupant co-borrower is included in the overall income. So while typically this is not an issue on a standard conventional loan, it might be an issue in these programs because they do have some income limitations. So for FHA loans, the co-borrower must be a U.S. citizen or they must have a principal residence here in the U.S. And FHA also requires the actual borrower occupying the home to have a credit score. So that's something to keep in mind with these type of non-occupant borrowers situation. All right. So another set of restrictions is going to be in the loan to value. So there are also for standard conventional loans like Fannie Mae and Freddie Mac, they will allow up to 95% loan to value if the loan is approved through an automated underwriting. However, if the loan must be manually underwritten, then the maximal LTV or loan to value is 90%. So that also applies for any home ready and home possible programs. And this can really make or break a deal, which is why we're talking through all the client situation before house hunting to make sure that everybody's happy. So FHA is restrictive in a few areas. So first, if the non-occupant co-borrower must be a family member as defined by FHA, so they cannot be a friend or somebody who is not directly related to the borrower. And they can only do this on a one-unit property to get the maximum mortgage of 96.5%. So taking advantage of that 3.5% down payment. If they're not a family member, as defined by FHA, or the co-borrower is the seller, then the maximum loan to value is 75%. So that's a huge difference in there. And sometimes we see this issue when a family member is, let's say, selling a property to another family member and is willing to help by being a non-occupant co-borrower while they're family members, they're also the seller. So that's going to reduce the borrower's maximum loan from 96.5% to 75%. So those are things that sometimes we can get creative with the loan if client cannot qualify, but if there's a direct relationship between buyer and the seller, we have some limitations in there. The next topic of consideration here is whether or not the occupant borrower, the occupying borrower, needs to have their own funds for down payment or closing costs. So let's dive into that one a little bit deeper here. Freddie Mac and FHA do not require borrowers to have their own funds on either an automated approval or on a manual approval. However, Fannie Mae is a little bit stricter. So if the file is not approved through automated underwriting, then Fannie Mae will require that the borrower have at least 5% of their own funds into the transaction. So there are two exceptions to this rule. One is that the LTV or loan to value is 80% or lower. And the second one is if the property is a one unit and the borrower uses like a gift or a grant or employer funds as down payment. The next issue lenders consider is debt to income ratio for the occupying borrower. So this is something that I really want to stress and go dive into a little bit deeper. For both FHA and conventional loans, the lender will take the total income and total debts from the occupying and non-occupying applicants and then calculate that into the debt to income ratio. So this debt to income ratios, they must meet like your standard guidelines and requirements for that program, just like any other borrower. However, suppose the loan has to be manually underwritten. In that case, Fannie Mae and Freddie Mac will require the occupying borrower to meet DTI restrictions. DTI stands for debt to income ratios on their own without the income of the non-occupant co-borrower. So FHA does not have this type of restrictions, and that's why we typically tend to do it as an FHA, because there's a little bit more benefits when it comes to doing so. This is a big one. So I get a lot of questions about kitty condo situation, especially when families consider the cost to rent versus buy, which is what I just spoke about earlier in a few slides with the client that we just closed on last week. And kitty condo, it's like a slang terminology that we see and we use a lot. And it refers to as when a parent, they have like an adult kid and they need the parent or another non-occupant co-borrower to help them buy a house. So this is what we use and see a lot because, again, especially right now with the current interest rate environment that we're in and all the different things that we see, inflation, the cost of living is just higher. And a lot of the times buying a home, it's actually cheaper than renting as long as the parents can help out with showing some sort of income in there. So for this program, again, the best program that we use is FHA because it's really the best known for this program. And it's used to, it always seems to be a good fit. So a lot of the times FHA mandates that the occupant borrower have a credit score, and typically conventional loans do not have this requirement. So depending on if that borrower who's going to live in the property, if they do have, let's say, a credit score, then we're good. We can use either program depending on what's going to be more beneficial. But if they don't, then we might have to consider conventional or traditional loans for that. So for conventional financing, the maximum loan to value is 95%. And the co-borrower is not limited to a family member, but the loan must be approved through what we call an automated underwriting. So for both programs, the lender considers all borrowers' incomes, assets, debts, and they don't have a minimum DTI, debt to income requirement. However, as I stated in the last slide, Fannie Mae and Freddie Mac will require occupying borrower ratios if the loan must be manually underwritten. So anytime that we don't get an automated approval and it has to be downgraded to a manual underwrite, some restrictions, more restrictions apply in that case. So that's something to keep in mind. All right. So if, let's say, for some reason you have, let's dive into this a little bit. Let me make it bigger. So if you have a client with no credit score or the co-borrower is not a family member, seller is a co-borrower, or the borrower needs a cash out refinance, then most likely conventional is going to be the way to go. If the borrower is low on funds, then FHA or conventional may be the best fit depending on the rest of their financial situation. And FHA is likely to be the best option when a loan is manually underwritten. So if we don't get that automated approval and it has to be downgraded, we might have to go the FHA route. And then when we combine the income of a non-occupying borrower and an occupying borrower, and let's say that exceeds any income limits for home ready or home possible, then we should look into a standard conventional FHA as our best choices in this case. So another important thing to mention is that all these programs apply for your traditional FHA and conventional. We are not allowed to do a non-occupant co-borrowers on VA loans and USDA loans. So that's something super important to keep in mind. Only applies in conventional in certain FHA rules in there as well. So that is all I have for you guys today. So thank you so much for coming, and hope this was a little bit of good information, and hope you gather or were able to sort of like know a little bit more about non-occupant co-borrowers. And like I said, it's something that we're seeing really often right now, especially the current rate environment that we're in. And again, if a client cannot qualify traditionally because, you know, either they're moving out of state, they just don't have a 2-year history to support consistent income. So there is just a number of different ways that we can get creative and make sure that we have options for our clients and not just decline alone without exploring other options. So thank you again for coming in. Hope you like this information. If you have any questions, concerns, feel free to share that with us, and we'll see you again next time on another webinar Wednesday. So thank you so much.